SCHD is an ETF that many dividend investors think is bulletproof. Well, today I'm going to show you some cracks that the experts don't talk about. Yes, the ETF has got a steady dividend payout, but there are hidden risks that could quietly be chipping away at your returns. Today we'll use AI to uncover where SCHD might be vulnerable, and we'll talk about what some smart investors are doing to protect themselves. Let's get into it. First, let's talk about why SCHD is loved by many investors. There are 5 main reasons. First, it has an extremely low expense ratio. For every $1,000 you invest in the SCHD ETF, it only costs you 60 cents for the fund managers to actively manage the ETF. Secondly, and very importantly to dividend investors, as of April of 2025, the dividend yield is 4.05%. So for every $1,000 you invest, you get about $40 in dividends. The dividend continues to grow. In the past year, it's grown by 16%, and it has a payout ratio of 61%, which is exceptional. Third, the ETF has performed very well, even without the dividends. In the past year, it's grown about 8%. Over the last 5 years on an annualized basis, it's grown about 17.3%. On a 10-year annualized basis, it's grown by 11.4%. So that means you're able to both grow your capital as well as get income from it. The fourth reason is that it has a lot of quality holdings like Coke, ConocoPhillips, an energy stock, Verizon, Altria, and Lockheed Martin. The fifth reason is probably why you're invested in it is that you don't have to actively manage the fund. For only a cost of 60 cents for every $1,000 invested, your portfolio manager is actively managing the fund, and they're only turning over the entire portfolio by 31.8%, allowing them to maintain a balance between staying current with what's going on in the market and minimizing unnecessary trading. A strong brand like SCHD often makes us feel safe. But this is where the AI comes in. I asked it to take a deep dive into SCHD holdings to find where there might be hidden stress points. I was surprised by what it found. First of all, I asked it, what are SCHD's top 10 holdings by weight? And this looks like a relatively diversified list, with stocks representing 4 different sectors, from consumer staples to energy, communication, and industrials. However, the top 10 holdings represent 41.4% of the total ETF. Now, that's a relatively concentrated portfolio when you compare it to other dividend ETFs like DGRO, whose top 10 holdings make up 26% of its assets versus 41.4% for SCHD. SCHD has also increased its energy exposure from 12.3% to 21%, increasing or adding names like ConocoPhillips, Chevron, EOG Resources, Schlumberger, and ONEOK. This shift makes energy the largest sector within the fund, above consumer staples and healthcare. As we move potentially into a recessionary period, the demand for energy is likely to decline, which represents a significant risk for SCHD. The second big risk that SCHD faces is the pressure that the growth of dividends face from inflation. Let's look at a few of its top holdings. Chevron and ConocoPhillips in the energy sector are currently facing rising operational costs. Drilling expenses are going up, equipment costs are going up, which are eroding profits. And as profits erode, the likelihood that dividends would increase declines. If oil prices do not continue to increase to mitigate the impact of increasing costs, the likelihood that the dividend will grow gets worse, which makes the decision to move even deeper into the energy space by the ETF fund managers look more suspect now. Verizon is facing inflationary pressures as well, with the cost of infrastructure development and maintenance going up. The cost of the iPhone is going up as a result of tariffs, which is a key to the growth of that business. Verizon is unlikely to be able to pass on those costs to the consumer, as it faces stiff competition from the other telecommunications providers. Altria is a consumer staple with a lot of raw material inputs, and it's facing inflationary pressures right now. So is Home Depot. In the consumer discretionary sector, highly influenced by the consumer's willingness to spend. With costs going up all around, the consumer is less likely to spend, which impacts profits and impacts the availability of income to increase its dividend, and hence impacting its dividend payout ratio. Here's a visual overview that shows you how just a little inflation might impact your dividend payouts. So you can see for Chevron is paying out 70.3% of its income as dividends. Verizon is paying out 60.5%. Altria is paying out 60.7%. Home Depot is paying out 60.3%. So any minor decreases in profit associated with inflation could cause the payout ratio to rise significantly, or force each of these companies to cut their dividends, which impacts your income. Let's even assume that dividends don't get cut. The fact is, in an inflationary world, the power of dividends decline because the price of goods and services continue to rise. An important point to note as you consider investing in SCHD. The third risk actually comes from something that should actually make investing in SCHD positive for you and I. It is how it rebalances its holdings from one year to the next. Rebalancing is what allows you and I not to have to be active stock pickers and rather passive investors, collecting income from dividends and participating in the appreciation of our original investments. But the problem is that rebalancing is a backward-looking action. It selects based on past conditions, not future economic circumstances. I asked the AI to tell me how SCHD's sector allocations have changed from 2024 to 2025. And you can see here that its largest sector has now become energy, growing from 12% to 20%. That is probably a wise place to be in economic boom times. But as we walk into a recession, energy companies are faced with higher costs, lower energy prices, and risk capital depreciation and a reduction in their dividends. Looking at some of its holdings, you can see ConocoPhillips was one of its additions, Schlumberger, which is another energy company, Halliburton, Murphy Oil, all representing being overweight in energy. This is not to say that rebalancing is bad, but it's just to highlight the risks associated with rebalancing based on backward-looking metrics versus forward-looking economic indicators. As the economic cycles shift, it can bring about risks that fund managers did not take into consideration as they work to rebalance the portfolios. The fourth risk is that several of SCHD's holdings are going to be impacted by the tensions that we see around the world, especially driven by the trade war. Take Broadcom, for instance. About 20% of its revenue comes from China. And with tariffs at 125% currently, it threatens Broadcom's revenue streams. Here are some other top holdings that are impacted by trade tensions. 3M has a global supply chain and its raw material come from all over the world. Tariffs directly impact its input costs. Home Depot, it's a consumer discretionary business. It's heavily reliant on importing goods from China and other places. Lockheed Martin, it's a defense contractor, which you would think might be defensive during a period of economic uncertainty, but it requires rare earth elements, which are sourced primarily from China. Any restrictions or disruptions here could disrupt its entire production and increase its costs. Pepsi operates globally, and it has acknowledged in its most recent reports that the tariffs have an impact, and it's had to adjust its pricing strategies and revisit profit forecasts to acknowledge the impact that the trade war is having on its profits. Verizon also is directly impacted by tariffs because its equipment costs and infrastructure development costs have been rising as a result of the trade tensions. So should you be adjusting your strategy? In my opinion, the answer is not to panic. The key is always to stay aware of headlines that might be impacting quietly beneath the surface of the assets that we own. No investment is truly set it and forget it, even though we would like to believe that they are. Sector shifts, inflation, rebalancing, and global tension all have an impact on the performance of the assets we own, especially ETFs. So stay aware as an investor. If you found this video helpful, please like and subscribe and drop me a comment. What are you going to be doing about this? Are you going to be adding more SCHD to your portfolio? How are you thinking about diversifying if you are? I look forward to talking to you in the next one.